In order to determine the direction of the market, you have two possibilities. You can either use chart reading or you can use indicator. As a technical analyst, you're assuming that all the information is already on the charts. So you can use chart formations like candlestick formations or head and shoulder formations to determine what the market is doing. Probably the most popular chart formation is trend lines. Many traders use simply trend lines to determine whether the market is going up, down, or sideways. The other possibility is to use indicators. Indicators provide a different view on charts. Almost all indicators are calculated based on the data that you already see on the charts. The high, low, close, and volume. Indicators are usually comparing these values over time or with each other. And many traders like to use indicators to determine which market the direction will go. My favorite indicators are Bollinger Bands, MACD, and the RSI. And I use all these three indicators as trend following indicators. I believe that every trader should have at least two indicators, a lead, a main indicator, and a second one that is confirming what the first indicator says. I also believe that you should not have more than three indicators because especially when you're day trading, it makes it more complicated and it leads to analysis paralysis. So how can you improve your trading in volatile markets? Very easy. Incorporate volatility into your trading. How do I do it? As an example, I like to use range bars instead of looking at time charts. On a time chart, you look at 5 minutes, 10 minutes, 15 minutes. On range bars, you look at volatility. You take the time element out and you incorporate volatility. This is what I like to use for my entry signals. For my exit signals, I like to use the average daily range to determine my stop losses and my profit targets. Yes, I like to work with profit targets. I like to take money off the market as long as it is there. Especially today in these volatile markets, the market can turn around on a dime. And if you're not quick in taking profits, you might end up in a losing trade, which has previously been a winning trade. Therefore, by all means, incorporate volatility in your trading by using range bars and by using the average daily range to determine your stop losses and your profit targets. Traders often ask me, what is the most important skill? What do I need to focus first when I start with trading? And the answer is easy. You first need to be able to identify whether the market is going up, down, or sideways. Or, in a nutshell, whether the market is trending or going sideways. Because based on the market condition, you select the right trading strategy. You use a trend following strategy in the market that is trending, in a market that goes up or down, and you use a trend fading strategy in a market that is going sideways. There are no hybrid trading strategies. You will see that a trend following strategy works very well in a market that is trending, but it will lose money. You get whipsawed in a sideways market. And in the same way, you will see that a trend fading strategy works really well in a sideways market, but you experience losses when the market starts trending. So therefore, before you even think about applying a trading strategy, first, learn to determine whether the market is going up, down, or sideways. And based on this, grab in your toolbox and select the right trading strategy. That is the secret to trading success.